Welcome back, everyone. Crude oil is dipping and treasuries are absolutely ripping. For tonight's video, we're going to take a high-level look at what is going on in the market, and we're going to go all around the map to different sectors and analyze what's happening under the hood. Without further ado, let's dive in. The S&P 500 had plenty of twists and turns throughout today's session, but it ended up finishing out the day only down 0.17%. That said, volatility was bid, which is different than what we've been seeing over the past 2 months, where volatility could not catch a bid. The Nasdaq finished the session down 0.41%. The Dow Jones was actually pretty close to flipping positive, as were the small caps. The ARK Innovation ETF was our biggest loser for today, down 0.78%. The dollar was down, and our long bond ETF, this TLT, this thing again could not catch a bid for the first 11 months of the year, and now suddenly this thing is on a bender. Our trend model remains at a -3. That is telling us that sellers are in control, and we have to respect that. The big laggards in the S&P 500 for today were Apple, Google, as well as Tesla, three massive components in the index that really served to just drag this thing down. Our sector map was pretty mixed throughout the session. We had advancers in the more conservative defensive areas of the market, such as healthcare, such as the gold miners. We even had an advance in the home builders, which is kind of odd. Our China internet names, which are at the top of our momentum list, also saw some profit taking. As we mentioned in yesterday's video, this sell-off so far is so much different than anything else we've seen throughout this year, because we actually have treasuries advancing, we've got crude oil declining, but yet equities are still under pressure. So what's going on? Our TLT long bond ETF, it bottomed out on October 24th at a price of $91.85. In just 2 months' time, not even that, we went from $91.85 all the way up to a breakout above value. And right now we're trading at 109.47. The only logical reason is that investors think either one, inflation is really about to slow and or fall off a cliff. We've seen a lot of evidence that points to that. The other thing is that investors believe the US economy is really going to slow. Based on the price action, we have to assume that it's more of the latter. Because if we were in a situation where investors thought, hey, inflation's going to come down and the economy is going to be all right, we would likely be seeing the treasuries rallying, but we would also be seeing growth stocks and really just risk on assets in general rallying, but we are not seeing that. Our ARK Innovation ETF is trading down to the low end of the range it's been in all fall, and it really looks like it is hanging on by a thread, as are many other groups within the market. The major theme for 2022 was the boom in commodities and the resulting inflation spike, and we have officially unwound that entire spike specifically for crude oil. Here's a tweet from what I believe is one of the newer analysts at Bloomberg. Shout out to Valerie. Oil erases all 2022 gains. Time spreads have flipped into contango, signaling a supply glut as global demand wanes. Think about this. Even just a couple months ago, the entire narrative in financial news, financial media, FinTwit, whatever you look at, it was, oh my gosh, crude oil, energy stocks are the way to go. We're in this new normal, and it's clear that we did not enter into a new normal. If you really just take a step back and you zoom out, most investors this year have gotten crushed on all of their speculative assets. Growth stocks took a massive tumble. A lot of those names are still down 70 to 80%. Cryptocurrency took a massive tumble. Even FANG stocks took a massive tumble. The one bright spot in the market was energy. This XLE ETF was a bright spot in the market, and I do believe that a lot of investment managers likely piled into this trade after the big run. Now, the big problem in the market is if everyone's now in these energy stocks, it was like the last bastion of safety, and now suddenly these are just getting hammered and they're getting crushed, we could be in a situation where it's December 7th and investors are just going, holy mackerel, I have no idea what's going to happen in the next year. This year has been a disaster, and I just want to unwind everything. And that could be what we are seeing now, where these energy stocks are just getting hit and investors are just going, let's start off the new year with a fresh slate. Let's just harvest a lot of these losses and let's just call this a wash. I know a lot of investors started to get pretty excited for the Santa Claus rally that often comes in December, but we have to remember right now we're in a monetary tightening cycle. The last December, where we were aggressively hiking interest rates and we were also rolling off the balance sheet, was December 2018, and the market actually took a massive spill that month. This is our weekly chart of the S&P 500, and this was back in 2018, and this huge red candle right here was December 3rd, the very beginning of the month, and we got 1, 2, 3 massive weeks of selling, and then on the fourth week we ended up bottoming out right around Christmas time. Now, I don't say this to scare you or to say this is definitely what's going to happen into the end of the year. That's not what we're here for. What we are here for, though, is really just to assess who's in control right now. Is it buyers or sellers? Are the sellers present? Are they among us? And clearly we can see from this red candle that we do have sellers among us. It's not up to us to determine when the sellers are going to disappear and anticipate that. It is much better for us to wait until they are gone before getting aggressive in the markets. That's exactly what we are doing. As of right now, the S&P 500 has had a failure at the downward trend line, and it really looks like it is hanging on by a thread to the low end of the range that we've been in for the last 4 weeks. Zooming back into the daily chart, we are trading below this monthly points of control, and we're still below that 20-day simple moving average. The next level that I am watching to the downside, and I know no one wants to hear this, is the 50-day simple moving average down here at about 38.40. With this said, however, we do have a pretty massive river card coming on Friday at 8:30 a.m., and that is the PPI data for November. Given the big rally in treasuries, I'd have to imagine that the market is looking ahead to the inflation data and assuming that it's going to come in lighter than expected. Normally throughout 2022, lighter than expected inflation data has been celebrated. But my fear for this report is that we get way lighter than expected inflation data, and that still does not stem the tide of the selling. In terms of our trading for today's session, the only big move that I made was I closed out 75% of the MBLY common shares that we had added at $30.47. I was able to take off 75% of this trade at our R2 pivot right here at around $32.94. I put this trade on yesterday, as you can see right here, and this was really just a test trade to see if we could get some traction in the market. We did end up getting that traction, and I was able to take most of this off for a nice winner, but this really was an outlier stock today. As I looked at the leaderboard for today, MBLY was like the number 4 stock on the list. This was actually one of the names from our Pristine Capital weekend watch list video, and we send that out to all Pristine Capital members every single weekend. If you're interested in receiving that analysis, access to our Discord, as well as all of our live entries and exits, visit pristinecapital.net and take advantage of our 30-day free trial. All right, now that that shameless plug is over, let's take a look at some of our sector ETFs and see what is going on under the hood. One of the standouts as we did our post-market scanning is this GLD ETF. This is sort of forming a volatility contraction pattern, and the fact that GLD is standing out against almost everything else is telling me that this is not exactly the ideal environment for making tons of money swing trading on the long side. Another group that's showing some pretty good relative strength throughout a lot of this carnage is the XLV Healthcare Group. This group actually had some responsive buying at the 10-day EMA, and I think this is where I'll be looking in case the market resolves to the upside. Crocs was a name we had on our focus list coming into today's session, and it actually held above the 20-day simple moving average. This being said, some of the more risk-on stocks within the market, as well as risk-on sectors, are really hanging on by a thread. A prime example of this is the solar energy ETF, which just broke below the 20-day simple moving average, and it appears this thing could be on a fast track for the 200-day SMA at about $74.68. The semiconductors are another group that's really just teetering on the brink. This one's trading right down to the low end of the recent range, and we're trading right at this monthly point of control. With all of this said, this is one of the most ambiguous situations that we've been in all year, and for that reason, I'm making sure to not be too aggressive in the market. Tomorrow's session is the session right before a big binary event. I don't see myself having a ton of trading volume tomorrow. I think the only big opportunity will be, let's say the market sells off huge into PPI. That could be a good opportunity to perhaps add some market beta. If the market just chops around again or has a slight green candle, I think it's going to be tough to get aggressively long ahead of this event. If you enjoyed this video, make sure to hit the like button, leave a comment, and subscribe to the channel. We really appreciate your support, and we will see you all next time.